Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we have Adam Sheldon from Keyboard Trader here to talk about the context in which markets move. So some of the bullet points that he wants to cover today include interpreting market action in the context of the events calendar, preparing for and trading the actual events, tactics for those trades, and then reflection and further positioning. Uh, I'm going to turn things over to Adam in just 1 second, but I want to remind everybody the webinar is being recorded. You can find the recording posted on BMT later today or tomorrow once the webinar is done. If you guys have questions as we go along, you can type them in to the questions panel on the left, and Adam will do his best to answer those questions. All right, guys, give me 1 second. I'm going to turn things over to Adam. Okay, Adam, you should have control. And I forgot to ask you before we started, did you want to take questions as they come, or do you want to hold them until the end, or how do you want to handle that?
Oh,
So
I think I'm muted.
I had you on mute. Sorry,
Oh,
you're
okay.
good to go now. I realized that once you were quiet.
I was wondering who's that kind woman just speaking to me. Okay, uh, you can ask the question, or bring the questions as they come. I
Okay,
might not take them in the in the midst of a sentence, of course, but
sure.
at the end of each section, I guess.
Okay, no problem. All right, it's all yours.
Okay. Wondering if I should leave this panel up here. I guess you'll let me know
It's
if I have questions, right?
yeah, just so you know, we don't see that. GoToWebinar
Yeah,
hides that on our side. But
but
I'll read the
if I have,
questions to you.
okay, that's great.
Yeah. All right. Thanks, Adam.
Okay. Thanks, Mike, and hello, everyone. Uh, this is the first time I've done this topic on a webinar, but I've lived this for the last 15 years or so. So it was kind of an interesting process for me to bring this together. So the name of this, the context in which markets move, the economic and events calendar. I've always thought that the way that markets move, it's almost inseparable from economic data, at least for certain types of products, financial products. I'm a gold trader. I also trade silver and some equity products, but mainly gold and silver. Other markets, of course, are less correlated to the economic data and events, but they give you an incredible insight into why things happen. And I want to give as much of a framework to you as I can possibly provide today. So one of the reasons I feel like this topic is not gone into too much detail on is that it's really hard to, unless you have a large data crunching machine, a Bloomberg terminal, or some other statistical package or mechanism for correlating futures data, chart data, to the economic data that's released every week or month. It's going to be a little bit hard to decipher, what the relationships are. I'm gonna tackle this partially from a data perspective, but more from just a psychological perspective and reflection, thinking about why markets move and how to prepare for that and how to profit off it. So the first thing I'm going to do is just go through this presentation. Then we're going to go through a few examples that help illustrate the points. We'll look at some charts. I can show you our order entry system for how I use the system to help me make money. And of course, we can take questions all along the way. Okay. Just to start off, these are extremely basic. Know the economic calendar. Everyone knows that when data is released that markets move, but the most important fact that people don't really think about is that markets move ahead of economic data. And this is something I'm going to give some really in-depth examples today for how to see this and how to prepare for it, because it's almost expectedly unexpected that big traders are taking off risk before reports. And I say expectedly unexpected because whereas if you get a weak data point, you know that if if you're watching the S&P today and you saw the durable goods number come out less than expected, you saw the market start tanking. However, what happens in anticipation of a big report? That's something that people don't think about too much, and they don't think about what kind of action they are likely to see. So that's why I say it's usually unexpected, even though maybe it shouldn't be. So just to give you an idea of the economic calendar, where to get one, assuming most people do not have the money for a Bloomberg terminal, I personally like the economic calendar that Bloomberg gives you for free. It's on their website. I think you just Google economic calendar Bloomberg, you'll be able to find it. And they also have charts on there. So typically, it's a good idea to know what's happening every week, every day. If there's going to be FOMC meetings or jobs reports, you want to know that a week ahead of time because the markets start preparing for that. The next thing to do to prepare for trading off data, and I say data and events really, because sometimes you have interest rate decisions coming from different governments. You have obviously the FOMC. You might have certain other things that happen that are more qualitative. Okay, so reviewing history. So I obsessively study data. I have a stats background, also a psych background, but I don't think that you can stare at charts too much. I think somehow if you just sit and stare at your charts and compare that chart history to your data, whether you're getting that data from Bloomberg or any other source, and you look at what happens, every time you get a retail sales number, and you look at how your product, whether it's the S&P, the Dow, currencies, gold, whatever it is, you look at how much your product moves in the context of that data. And so, for instance, yesterday the home sales was, I think it was like 30,000 lower than expected. Going into that, I knew, that roughly, how much the home sales will usually be above or below expectations. What's the, a deviation? I can say standard deviation, but I'm trying to stay away from statistical terms because that's not exactly what I mean to say. Is the number usually between 300 and 500? Is it usually between 350 and 450, something like that? So you can start to, if you start, learning and seeing the range of the history, it can give you an idea of how your product will react. At the same time, you're looking at the range of your economic data releases. You want to look at the range of your product. So for me, that means if the home sales comes above or below expectations by 5,000, no biggie. If it is 50 off, what will that mean to me? It doesn't mean the same thing every time, of course, and we're going to go into that later. But it helps give you a guideline, right? So next bullet point here: learn how markets react to data and news. This is pretty simple for most people. If you get a strong home sales number, what that's going to mean for the dollar, the euro, sometimes the equity indexes. They've been a little bit tough, I would say, until recently to figure out. Gold, it's pretty straightforward. A good number is bad for gold. The amount, that's obviously important, but I would say more important, just is it a temporary blip on the screen when you get a number that comes out, what your product does, or does it set the tone for the entire day or week? Obviously, the bigger the report, the more that it will set the tone for the rest of the week and the next week after that. And who knows how long it will continue, of course, but if you have a jobs report, which typically happens the first Friday of every month, and then if you have usually have a moderate amount of economic data the week after that, but still the jobs report is such a big report. Once that's out of the way, markets move pretty strongly. But if you know that you have one big report, let's say a retail sales number, and then you have nothing coming for the next 3-4 days, that number might have more effect than it would otherwise. I also have some more notes here I'm looking at aside from the screen, which if anyone wants, I can email them copies of the notes for this in case people are interested. All right, let's skip to the next slide. How will it play out this time? So if you were to ask the average trader, amateur trader, maybe intermediate level trader, everyone says, fade the news, buy the rumor, sell the news. Well, I personally believe, and this is after, I've been trading since the late 90s. I don't know what this rumor is, but no one's telling me about it, because I always find that if there is a rumor, it's more maybe in the stocks, specific stocks. I don't think there's really too many rumors that are worth listening to, that are worth preparing for, that come out for futures traders. Yeah, I mean, you could say big picture, the Fed might taper, the Fed might not taper. Okay, if you call that a rumor, then fine. But I don't really believe in, buy ahead of a report, and then after, what you think is coming out, then you liquidate after that. That's, maybe it's a good strategy for some people. For me, that's never been something I've been good at. And again, I have a stats background. I love data. I love math, but I've never been good at predicting economic reports. Even if when I used to correlate, I used to have a huge database that I would maintain. I could never predict economic reports. So I just forget about that. So what usually happens when data comes out? And when I say data, I mean jobs report, retail sales, durable goods, the weekly jobless claims, crude oil, API inventories. If you are watching, if you have certain products like warehouse stocks are important, or export sales are important. It could be anything. Usually, the initial reaction is just as you would expect. If you have higher stockpiles of a certain commodity, if that is a larger stockpile than expected, that price will usually go down. Retail sales is stronger than expected. It's usually good for stocks. However, as I said lately, that hasn't been too great a correlation. If I was trading equity indexes lately, or for the last year or two, I would actually be pretty excited right now. I personally find the S&P hard to trade. I personally like the mini Dow, just because of my order entry system that I use. It works better for it. I like the fact that there's more ticks, that there's a wider range and more movement. It helps me get in and out faster, or without paying up, I should say.
Hey, Adam, just real quick, can you let us know, give us an idea of what type of trader you are? Are you scalping? Are you day trading? Are you swing trading?
I have struggled with that question probably more than most, because traders always ask each other that question. I would say I'm more playing for breakouts and for I'm playing for bigger moves. That said, and less on the range trading. But if you're focused on one product, and I usually am focused on gold, I trade gold 70% of my volume, then silver, copper, platinum, mini Dow, and some others, some agriculture. But if I were to, just because I'm focused on one, if there's not going to be a breakout and I'm expecting a range kind of day, and gold makes a new high or low, I will usually try to fade that move. So that's going in the opposite direction. So I would say I prefer, and I do really, really well on breakouts and trends, but I will fade and do mean reversion techniques if I have to do.
Right. But are you usually flat at the end of the day, or I'm just trying to get an idea for how long your trade duration normally is.
Yeah, so I used to. I can give you two types of answers here. Let me give you the answer to the question that you asked, and then I'll give a little tweak on that. So a few years ago, when gold was in a steady trend, and I was able to predict what would happen overnight more. And that was when I say I was able to predict what happened overnight, I felt that I was better at it because the overseas markets didn't have as much of a role in the price of gold. Now, in the last few years, China's become much more important. India's always been important, but China's become much more important, and I feel like the overnight moves are a little bit less predictable. So I used to hold positions overnight, and the size of my positions would be about only 1 or 2% of my total trading volume. So I might do, I mean, a few years ago I might have done 500 round turns in a day on average. Now I'm doing a few hundred round turns, but maybe I would hold 5 lot or 20 lot overnight a few years ago. Now I'm almost exclusively, I'm almost always closing positions at the end of the day, and if I see moves that while I'm watching it at night, I will sometimes take a position and go to bed, but I don't sleep as well, and
Okay.
I'm not as comfortable as I used to be. But I do expect at some point I will be back on that train.
Right. Well, that helps. Thank you.
Let me just answer the other question that I want to the other question that you didn't ask that I'd like to answer, which is what is the most profitable length of time to hold a trade that I don't think most people pay attention to. Most people study charts and they say, okay, if I enter the trade here and maybe I put an OCO bracket around it, they just kind of look at their targets, but they don't think in terms of time stops. When should I get out of this trade? And they don't think in terms of when should I be trading and how long should I be trading. And I've done a huge amount. When I say a huge amount, I've probably analyzed hundreds of thousands of trades, of my own trades. And this is a separate topic. We could do a whole webinar on this topic. But I've personally found that if I close out a trade within 10 minutes, it's usually profitable. After 10 minutes, it starts going downhill. So just word of advice. I mean, if you have enough trade history that you can download it and study it, you would probably have to do some analysis in Excel or some other data analysis tool. But you can study how long is it profitable for you to hold your trades, because once you lose your mental faculties and you can't pay active attention anymore, it's going to hurt. So. Okay, I forget where I was, but okay. So how will it play out this time? Yeah, usually initial move is as expected. Let's just talk about the S&P for a second. So yesterday, new home sales disappointed. Stock market went down. That was what was that? 8:30 Eastern, right? I personally like seeing that because it's predictable. And as I was saying before, it hasn't been predictable for a long time. Usually good economic news, it usually makes it more likely the Fed's going to taper. Bad economic news, less likely they're going to taper. Well, now you saw it yesterday on the bad data, again today on the bad data. Today, the stock market sold off on the bad durable goods number. So I personally think this is great for anyone that wants to actively trade off the data. It just makes it predictable, and I like the volatility too. Anyway, I want to make a few points on how will it play out this time, because you can basically say yeah, if we get a bad durable goods number like we did today, if the market is following the data, you would expect it to sell off. But there's a lot of times that doesn't happen, and I think it's extremely valuable to consider when things might be counterintuitive. And I can interpret that for gold better than I can do for any other product. And I will give an example later that is focused on gold and also the S&P too. But I will just say for now it is extremely important to consider when will big traders, when will big money want to be taken off the table. Let's look at it this way. So let's say, and I'll give an example for gold, and I'll show you the charts later. You've had a short, a big downtrend going for a long time. I guess you could say it got really active this last April, actually. I forgot we're in 2014. Everyone's short, right? Everyone's looking for more money. Yeah, everyone wants to make more money on the downside, but every once in a while, you have to take your profits and look for a better entry point. So the best times to do that are usually before there's going to be a lot of risk. So if you don't have a heavy economic calendar and things just look like they're just going to continue as is, why would you take your winning bet off the table? You usually wouldn't. We're going to look at the chart later for what happened in gold in December, around but before the time of the taper, to look at some of the activity there. I know most people won't trade gold, but it can hopefully give you some insights in how you can trade the stock market indexes, which I know everyone trades, or other products too. It's basically a way to think. For now, let's just go back to the average moves. You have regular economic data that comes out every day, every other day. You will start to see patterns. So yesterday, the market sold off on bad home sales. Today, it sold off on bad durable goods. In the past, that wasn't so predictable. Now it's starting to become predictable. 2 reports in a row that I've seen, right? So what happens next time? There will be some kind of element that the market's going to sell off on a bad number. But let's say it happens a little bit less. Let's say like whereas today, maybe the S&P went down, I don't know how much it went down, maybe 6 to 10 points on durable goods. So maybe next time it only goes down a point or two for no good reason. Maybe there's nothing else at the time. Maybe the earnings releases were nothing interesting there, and it basically just didn't sell off as much on bad data. To a large miss in the economic data. So you always use what happens last time as a guide towards the present. But if in the present, or in this case in the future, the data did not move the market as much, you should use that next time. So next time, you should be looking for some kind of trend that includes what happened this time. So I always think about it this way. Everyone says that history doesn't repeat, but it rhymes, and I think that's extremely true. So, and we'll go into examples. It'll be easier to see once you see the charts. But you should always be looking at what was the last few reactions to the reports. What's the current reaction to the report, and what's coming next. So if you have, like tomorrow we have an FOMC, meeting here. So does it really matter if we had a consumer confidence that missed by 1 point? It doesn't really matter at all. Does it matter if durable goods missed by, 6 percentage points or something like that? Yeah, I would say that's significant, but it's probably not going to affect us too much tomorrow. I don't think it'll affect us, but maybe it will a little bit. Maybe it will push the Fed over the edge of skipping a meeting. So you always have to weigh everything in terms of the context, of the current calendar. But I just want to make the point that if you start to see a trend in how the stock market indexes or whatever product you follow reacts to data, you have to know that relationship changes over time. You want to take into account what happened the last few times, but it is by no means reliable. I would say it changes. The theme kind of changes I won't say every 3 or 4 reports. I don't want to give the idea that there's a new theme every 3 or 4 reports, but I would say once you have a few reports where a theme becomes obvious, people start front running that, and you won't see as clean a reaction the next time. All right, so preparation. So you know that you have data coming out today, tomorrow, and you want to be ready for it. What's the best way to prepare? Number one, Squawk Box is probably the best thing you can do. I realize not everyone has the financial capabilities of paying for the Squawk Box. I personally love Trade the News. I use their version, I forget, maybe it's their credit version, I forget. It's $185 a month. I'm not affiliated with them. I just happen to love their service. But I know there's lots of other free news outlets. The question is, how fast is it? I know it's something people don't think about that much. What is the delay of your TV? In my house, I have, and I work out of an office, but in my house, I have DirecTV, where one TV upstairs is about 5 to 7 seconds ahead of the TV downstairs. And if you were to watch streaming Bloomberg over the internet, I found it was like 40 seconds delayed, even at my office on a nice solid internet line. So you have to listen to real-time data. If you are getting this data, you know, from some free service or over cable TV, you have to make sure that it's that you're getting it live. And personally, even Bloomberg, which is I think the best business news channel, you're still getting it delayed. Excuse me for 1 second. So I haven't done the research on what all the best free methods are, but I would just say if you're trading off of data, you have to do that. Okay, I put here the best opportunities post-data are within 1 minute of data release. I question that myself a little bit. I would say, yeah, that's true. I would say depending on the number that it is. I would say within a small, not so important number, that's true. Within a jobs report, I would say you have good opportunities for about 10 to 15 minutes. After that, I have personally just, in the big picture, made more money in the first 10, 15 minutes, and I won't say I've lost money after that because I don't know that I have, but it certainly becomes less profitable. So we're going to look at some charts and see what you can profit from and when to call it a day. Or not call it a day, call it a trade. We'll call it that. In preparation for economic data, I put here this second bullet point in the middle. Exit positions 5 to 15 minutes before report or hours or days for important events. I realize taking positions off for hours or days is not exactly possible, but I put there just to keep people thinking about this appropriately. If you are a beginner at trading, trading a news event is probably something to avoid. If you are intermediate level, you can make a lot of money if you're very careful and you have a really good strategy. But you have to be careful. And one way to be careful is to avoid things you don't understand. So if you don't understand the Fed and how they're trying to influence the world markets, yeah, I would say it's a good idea to take your positions off within a few days of the Fed coming out with their statement. You might say the same thing of a jobs report. But for most reports, let's just say a jobless claims or a durable goods or retail sales, usually 15 minutes is good enough. Now, why do I say exit positions? Some people, again, want to predict what's going to happen. I just usually look at that, unless you have an economics background, unless you have I don't know, I feel like more of an edge in political science in these markets than economics sometimes. But unless you have some kind of degree where your expertise is studying data and knowing what is going to happen next, what's going to be released next, I would say exiting positions is the safe trade, is the safe way to approach an economic data release. Why do I say 5 to 15 minutes before? And that number 15 I feel like is a little bit more accurate. If you look at let's say, 30-minute chart, 5-minute chart, I guess look at various time frames, 1-minute chart, and you just study what happens at 8:30 Eastern Time, 7:30 Central, when most data is released, or 10 a.m. Eastern, and you look at what happens in the 20 minutes before that on days where there's economic data. I personally, in the products that I watch, notice a lot of, you can call it reversion towards the mean, you can call it people taking off positions that they had prior to the report. I guess that's a better way to look at it. When I trade gold, there might be a short bias because everyone's been short. However, before a data release, you might likely see some short covering. So why are people doing that? They're doing that because they don't want to have their money, their profits. If they were short, they have profits. They don't want to have those profits at risk before an economic number, right? And usually, for the average size report, that I don't want to always call it reversion towards the mean. That could be a little bit misleading sometimes, but that that action that reverses the prior trade of the, let's say, last 12 to 18 hours, we'll call it, from yesterday after the markets closed, including the overnights, through the morning, whatever that trade has been, you could say the stock market has rallied 10 points, maybe it starts to give back 2 or 3 points. Gold, maybe it sold off $10, maybe it starts to rally $1, $2, $3 before a report. It's just people that have some money keeping, protecting it. So why I personally feel like it's a better idea to give up your positions before report, I already mentioned. You might ask the question, if what I just said is predictable, if it is predictable for markets to kind of revert towards the mean, not my favorite terminology, but if that's the tendency before a report, why wouldn't you fade a strong move? And the answer is simply that it has to do with avoiding risk. If you know that a heavier risk situation, i.e. a data release, is about to occur, it doesn't matter that that you think you can predict something. You can predict something in an environment that's becoming more risky. The likelihood that you're going to get caught in a bad situation goes up, and if you're caught in a bad situation, now you're thinking less clearly, and you're not able to take advantage of what's going to happen as soon as the data is released. And for me, and some of the things I want to show you, I think once the data is released, you have great opportunities to make money, and if you're not ready with a open, with no position, and and thinking clearly, then you are at a disadvantage. Okay.
Hey, Adam, there's a couple of questions on the board right now.
Sure.
Julie's asking about bracket trades, and specifically, how do you combat pre-news release block trades or bracket trades firing off only to snap back and reverse? So can you comment in general about bracketing around news and whether or not that's something that you do? And then I guess further answering the question is that we've seen most of the time, I would say, post-news, that the market does not just go in one single direction. So any comments on that?
The second question, I will show examples of how I handle that in extreme detail. For the first question with bracketing, it's something I've always been curious about and always thought about, but I never do it. I'm not saying it's a bad strategy. I would say it could be a decent strategy, but one that's probably worth, I don't know, you can test it, but what you can do is you can study history a lot for it, that's for sure. So look whatever, I don't know if you're talking about economic data, like for the general indexes, or whether you're talking about a crude oil report or whatever it is, I would study the various markets, and I would basically, you know, look at if you have data down to the second level. I don't know if you can get lower than that on a lot of systems, but you know, look at the move that occurs, or where look at where the product is trading. Let's say 1 to 3 seconds after, or let's say 2-3 seconds after the data is released, and if you can see that there was a fake out from 0 seconds to 1 second that occurred before that, then bracketing is probably a bad idea. But if, you know, 7-8 times out of 10 there is no fake out, and the move that occurred once you know, normal people were able to respond, and once you could see the data show up on your chart, you know, after, you know, let's say usually a third of a second for a lot of platforms, and you can say 7-8 times out of 10 it's reliable, then yeah, maybe it is a good strategy.
All right, one other question real quick. Yeah, from News Trader asking about the various kinds of markets. So you've mentioned that you're primarily trading or exclusively trading futures. He wants to know about trading equities or Forex. Any comments on news trading on non-future markets?
You know what, just a little humorous tidbit. I remember there used to be a time when some banks would guarantee, this goes back to the prior question about bracketing, that some banks, I don't know who it was, or it was through the platform, through trading platform. I remember with TradeStation, that people that were trading through TradeStation and maybe other platforms, certain banks would guarantee pricing if it pushed through a stop. This was probably 7-8 years ago, but if you put a bracket on in Forex, you would actually be guaranteed to get filled at a price that you would put in there, which to me is ridiculous. It was an easy way to make money that no one knew about. Anyway, yeah, I mean, you can use what we're talking about for Forex just the same as currency futures, for sure. I personally prefer just watching markets that are, you know, during the hours that that everything else is going on for me at. So if I focus on the metals, I will focus on you know, other currencies that are active during that time. But I would have a hard time trading the euro yen because I don't really understand the foreign governments as well as I understand the U.S. governments. And you know, this is just a personal, you know, we all have things that we understand. You know, you could mention Warren Buffett right now. You know, only do what you understand. So if you have an edge in the Australian dollar or Aussie versus euro, by all means you can use these techniques. I would not know the first thing to tell you there, though. And stocks obviously are different because it's all company related. But obviously some stocks will follow the regular news releases. I mean, a lot of them, a whole heck of a lot of them will actually. But I don't know. Is it safer to trade SPY or whatever the Qs are, or is it safer to trade what a leading stock in a certain sector, in the banking sector or in technology? I would say you would probably know that answer better than I would. And you know, I believe in sharing knowledge, or I wouldn't be doing this webinar. But I would say if there's one thing that traders can learn that's more important than anything, it's to trust yourself. So if you believe that you see something going on, that you have an edge in certain stocks that follow economic data releases, then you probably are seeing something correct. Either that or your loss of funds will prove to you that you were wrong. But you know, in general, I feel like for stocks, the better opportunity is earnings and other news. It's not really you know, as clean as the indexes for trading data releases. Is that good, Mike? For now?
Yeah, all good. Thanks.
Okay. All right, so I put down here at the last bullet down here, imagine expected trading ranges. You know, by the way, Mike, how are we on time? Should I just continue at this pace?
Um,
I'm sorry,
I,
how much time should I?
most webinars are about 1 hour, so that would give us
Okay,
another 20 minutes or so.
okay. All right, let me go through these these last points, last few points quickly, and then we'll go to the charts. All right, so I said imagine expected trading ranges based on different numbers. We'll just go through that quickly. You know, durable goods, if it comes within 1 or 2 percentage points of expected, how far would that push you in one direction or the other on average? If it goes 5 or 6 points like today, how far will that push you? That's the kind of thing you just want to have an idea of ahead of time. Action positioning. Compare expected trading ranges with market action as it happens. Assess and trade. This is something that I'm not sure how comfortable people are yet. I'm going to show you how I do it, and I think there's a great opportunity here, but it all depends on your style and if you're comfortable with this. Next bullet, fade moves that occur towards the sides of your expected trading ranges as soon as they stop moving. So we'll look at that when we see the charts. Only play for further breakouts if your data analysis suggests a more dramatic move is imminent. So I'll talk about that now. So let's say I can't talk about the S&P because the move, you know, the data has not been correlating to the economic data as much recently, in the last 2 years, aside from today and yesterday. So there's less to go on there. But for me, if I see a really bad durable goods number, I would say, you know, that should be $5 to $10 in gold, $5 to $8 maybe. If I see, you know, missed by a percentage point or two, maybe gold moves a buck or two. Initially, I'm not talking about what's going to last, just initially. Usually, the trade, the amount of time you have to make your trade is usually within 1 or 2 minutes, up to, for a much more volatile number, 10, 15 minutes. Depends on how big the move is. And then the last bullet here, reduce position and exit as volatility and volume drop. That's what I'm talking about here. So a retail sales comes in, 15,000 against expectations, you might have a minute or two, or maybe 3 or 4 minutes to trade and have some kind of edge. A jobs report, 10, 15 minutes or more. Okay, so let me jump to some charts and just make some points. This, let's hold some questions for now because it's going to take a little time to run through these examples, but I think they're pretty helpful to see what happens in the big picture. So the first thing I'm going to do is talk about gold on the days of December 4th and December 6th of this past year. And what I'm going to do is show you what that calendar looked like. This is the Bloomberg calendar that I was talking about. So 8:15 a.m., December 4th, about 6-7 weeks ago. If you remember, this was 2 days before an employment report, right? And this was 2 weeks before the FOMC on December 18th. Everyone was saying, oh, I don't think they're going to taper. I don't think they're going to taper. But the big money has been short gold quite a while. And if you look at this downtrend, generally, this is, since April of last year, gold's been coming down. This is a daily chart on the left side over here. And if you look at December 3rd, December 5th, let's see, December 4th, it's right here where I'm pointing to. It's been coming down for quite a while. And now I want you to look at a 10-minute chart here. This is gold on December 4th. We had an ADP number. If you look at this data, it actually came out 20,000 above consensus, okay? And initially, gold was here, 1221, and gold sold off to 1213. So gold went down $8 on an economic number that was better than expected. You would say that's as you would expect. That nothing is surprising there. But what happened after that shocked a lot of people. And I think the reason it shocked a lot of people is because everyone is only remembering the past. Everyone, if you look at this chart and you look at where we are, 1213, and if you look on the chart right here, 1213 is down here. Everyone's experience up until this cross in time was gold goes down, gold goes down, gold goes down. It just, that's what it does, right? It goes down on economic data. It goes down because the Fed's going to taper. Well, people forgot that 2 days later, you have the biggest report of the month. And 2 weeks later, you have the biggest FOMC meeting. I say biggest FOMC meeting, I guess, looking backwards. I personally expected them to taper, and I know no one will believe me that, except for the people that I talked to beforehand. But if you have two major events coming up, 2 days from now and 2 weeks from now, you have to do what the big players do, which is remove some risk. So these big traders basically were given an opportunity to take more profits at 1213, and they covered because they were taking risk off the table. And I think if you talk to the average amateur trader, intermediate trader even, and you say, let's talk about the influence of data on markets, 99% of them will tell you about what happens after data is released, and almost no one talks about what happens before data is released, and that is just as important. And that's the reason that gold spiked $35, $40 right there. Now, let's skip a few days later. Now this December 6th, employment report comes out. This one, consensus 180, actual 203, consensus unemployment rate 7.2, and it came in at 7. Now, on this one, initially gold sold off. Now, it spiked again. Why did it spike again? Well, first of all, I would say it's a combination of two things. It's a combination of the fact that 2 days before that, people learned that there's traders looking to cover their shorts. That's number one. So you're looking backwards. And if you look forwards, you know that there's an FOMC meeting coming in 2 weeks. So you have two solid reasons. Risk aversion and short covering are both in the cards. And so, the instinct of gold on a good number is to go down, and that's what it did. And then there was short covering. And after that, you could say the reason it came back down and went all the way back into this range, I would say it's the fact that if you look at the fact that 2 days ago there was some short covering, a lot of that short covering was because there's two major reports coming, the FOMC report and the jobs report. Well, one of those is now out of the way. So people learned here you have to cover your shorts, so they did. But guess what? Now there's less risky events coming, and that's why I think it came back down here, right? So what I'm trying to show you here is to think about economic data releases as things you have to prepare for by and what might happen after they occur. You also have to think about what's coming next in the economic calendar. All right, let's jump forward to December 18th. Where is this here? Let me switch to a 30-minute here. Wait, why is my data missing? And I'm also going to now compare this to, here we go. I'm also going to compare this to the E-mini S&P. All right, this is now December 18th on two different charts. Right here is the FOMC meeting for gold on December 18th. This is what I'm pointing to. And right here is the S&P reaction. Now, I don't know how many people watched the media reports after the FOMC statement that they were going to taper, but they were also going to extend the time frame for which they'll keep low interest rates or something like that, right? And everyone talked about, well, look what happened. The stock market went up and gold went down. This is the best of both worlds. This is great. and they look at the Fed statement for explaining that. And I was arguing with people after this for a little while about this. That's not what happened. The Fed did not make the perfect move. The markets did not interpret this statement, and based on the statement, the stock market went up and gold went down. That's not what happened. What happened, and this is of course my opinion, but what happened was, forget about what the media said. What happened was that before the FOMC report, the gold traders had taken risk off the table. In other words, the market was generally short gold, and they pulled some of their shorts off the table before the FOMC. So you have people that want to be short gold that are not, right? They're not short gold, but they want to be. Meanwhile, what happened, if you look at December 18th, here we are in the S&P, December 18th, this day right here. The stock market's been going up for quite a long time, right? But in the prior, what was that, at least 1 month, you could say even 1.5 months, it's done nothing. It's gone sideways. Why is that? Because people are taking off risk again. They want to be long, but they've taken off their long positions because they don't know what's going to happen. So as soon as the statement was released, people put their positions back on, and that's my main point. You have to look at economic data releases as times that people will reduce risk before and add risk after. So forget about what the media said about that people interpreted Fed in a certain way based on what they said, that this was great for equities and bad for gold, and that's not really what happened. What happened was people wanted to have long positions in the S&P, and people wanted to be short gold. They took the risk off before the report, and they put the risk on after the statement was released. Now, let's just jump forward to, and Mike, I realize we're probably closing up here. I haven't even really, I don't know if you can hear me or not, but I certainly could not.
Welcome to GoToWebinar. Webinars made easy.
You want to say something? I'll try to read it.
Can you hear me now?
Yes, I can.
Yeah, I don't know what's going on with my mic. Sorry about that. I had to just plug it back in.
No problem.
No, I said take your time. Go ahead.
Okay. All right. So, yeah, and this is actually where we get to the point where I was going to show you, the more ingrained detail of how to use, how to trade data releases and how I use our product, Keyboard Trader, to do so. I'm just going to look at a few quick examples here. And hold on, I'm being held hostage by my mic right now. Okay. Let's look at yesterday. Is this January? Yes, January 27th. Okay. So I'm looking right here, 9 a.m., new home sales yesterday. Stock market sold off down to here. It looks like it sold off about 10 points, almost 10 points or so. And then today, 8:30, here we go, durable goods, okay? All right, looks like that's all. Here, let me move to a 10-minute. Okay, there we go. All right, so, and then up here, this is gold. Let me find today, which is 7:30. Let's just look at durable goods, which is what happened today. All right, so gold has been. Let me do a 10-minute actually, just so you see the context of this. Actually, I changed my mind. Let's do a 1 minute. How about that? Let's see if we can make this work. Yep. All right, this is better. All right, so the market. Forget about what happened before this. So we could look at the prior few hours. It's just not going to be easy to do in this chart. 7:30 a.m. Central, 8:30 Eastern. Durable goods number came in. It was much worse than expected. Missed it by 5 or 6 percentage points. Immediately, gold jumps right here. Okay. Now, gold has been in a little bit of a range, and you look at what happened yesterday. It came down a lot. But that was after a rally of a significant amount. kind of told me it was going to be a range kind of trade today, mostly because there is some pessimism about the Fed tapering tomorrow, at least that being expected. But then you also have some short covering, which could be expected too, prior to an economic data release, just like we were talking about before. But if you think about a big disappointment in durable goods, is that going to send gold, $2, $4, $10? In this context, it was at 1254, let's say 1254 even, and it initially jumped to 1257. And I would say, hey, look, the range here, if you draw a channel here, you could say the upper channel would go like this, and the lower channel would go like this. So if gold bounces here initially, this goes to one of the first points I was making. If in your preparation you say, yeah, a big disappointment of this magnitude will probably send gold up significantly more than $3. Aside from that, combine that with your chart analysis, and you say, yeah, why the heck can it come up and test the top of this range? That's exactly what I think it would do. That's the way I traded it today. I looked at this and I said, hey, I will take anyone that sells gold to me on any dip. So the way that I would execute that, and I will show you with my keyboard. We're not going to have time unless you want to stay over time. The way I will do that is I will have keys on here. I'll have my fingers on different keys. So if I'm ready to buy anytime someone's willing to sell it to me, I will have my fingers near these blue keys for buying. I can use icebergs to hold this down, and I will buy anytime the market goes down and stops. Usually for me, my biggest edge is being the first human trader to place trades after the market moves towards the side of an expected range that I have in my mind, and then it stops. And I'm the first one that's joining at that level, paying a higher price, or maybe slightly below that level. So let's say I wanted to hold a position of let's say 10. I might buy some here, or I might go all in here. I would usually go part in, and then I would try to sell in the first spike. So if it spikes and it goes up here, then I might sell half. And when I say it spikes here, I mean spikes and stops. So if it spikes and stops, I might have a key that's designated to sell, part of my position, or I might just, just do, hit something a few times, whatever it is. I might just liquidate the position I'm holding. But generally, I'm looking for it to kind of jump up and down. That's typically what happens after data. It finds a range. Now, in this case, the range is steadily climbing up. And in this case, also my expectation is that it's going to test the top of this range. So I don't really want to give it up too quickly. So I am buying some, selling part, buying some back, and then once it hits the top of my range, I'm liquidating. The fact that it comes down here, was I going to buy it here? I am really not that excited about buying it here, and I say that modestly because it did go up and make a new high, but the reason I didn't buy it here is because it already did what I expected it to do. The whole trade here was you buy it underpriced, in my opinion underpriced, and then you liquidate it at the edge of its expected range. And in this case, it already did that. And once it does that, what I find is that things usually change the way that they trade. Now, in this case, it made a new high by a significantly further amount, and then it ended up going all the way down. So I didn't get this last bit right there. But also, once things move sideways, if you remember the last bullet we had on one of those slides, it was that, once the volatility and the volume drop and things starts going sideways, that's the end of this trade. It doesn't mean it's the end of trading for the day. It's just the end of this trade. Now, so in any event, I'll just show you the reason that the keyboard and the reason I had this product built was I find a lot of use in being able to do any number of things as quickly as possible. So if a market, like let's say you're watching this market over here and the market's jumping like this, and you're trying to catch it, you always have to move your mouse to a certain location and then click something. Or let's say you realize you're trying to buy it, and all of a sudden it reaches the top of your range, and now you want to liquidate. Well, now you have to start canceling orders and start moving your mouse to the other side. and it's always with the mouse one thing after the other, and that's why I feel there's such benefits with our product. But let me go to the S&P. So the S&P, as I showed you from yesterday, we had yesterday was 9 a.m. The market sold off on bad economic data, and to me, what that tells me is that's a reason that I will do the same thing if that happens again today. So today, 7:30, right here, durable goods. Now, I actually, I don't want you to think that I am active in gold and the S&P or Dow at all times. I'm usually just choosing one or the other. It's almost always gold for me. But let's say the market comes down. You see, again, bad economic data. The market comes down, and I don't know when you get in. This is 1 minute of time here. Could you physically get in if you were trading manually over here? I don't remember what happened, and I don't have something that shows the seconds here. But let's assume that you could get in somewhere here. Now, when would you hold that position to? When would you get out of it, and what would you do after that? So let's just look on a 5-minute chart. Maybe that's easier. So let's look at a 30-minute chart. How about that? It's the hardest thing to do. It's harder than trading, finding the right time frame to look at here that will show something I want to show. All right, this point right here is when the data is released, and when it was released, it came down to here. So if you knew that yesterday a 30,000 whatever it was miss on the home sales sent the S&P down 8 to 10 points, and you say the equivalent, let's say disappointment in durable goods, which is usually more volatile, but still an equivalent kind of disappointment. It sent it down from 83 down to 76, almost the same amount, actually. And you'll notice that that was actually near the other support level. So, however, yesterday, you'll notice, initially it went down here, and then it continued much further, but that wasn't until significantly after. Basically, if you had looked at your history and you knew what the average move was in this situation, or at least you used yesterday's guide as an example, you look at the volatility, then you can have an idea in your head of where a good point to cover your short is. So in this case, let's say you got in somewhere here or somewhere here, and you said, I think it's going to go a little bit further. I want to join this move on the downside. So you sell. Let's say you're using a keyboard. If you sell, you push a key, and now you're waiting for it to go down and go down, and it's not going anymore. Maybe it's in here. So you don't actually lose anything, but you don't gain anything either. No problem. I would say that in between this time frame, there's not much to trade that looks too good in this area. I personally like things that stick more with channels that occur within 10-15 minutes after a data release. That's one of the reasons I love gold so much, because if you look at gold, in the 10-15 minutes after this report came out, it reached the upper end of this range, which I would say this point right here was predictable. Although I guess you could say if you waited 30 minutes, or then you could say when it bounced up here, which is not exactly to the drop-off point, but pretty close to it. So I guess there's some things you can do after that data was released. And I guess you could say, if you look at this point down here, this bottom point, this occurred around where the other low was. And no one has asked this question, but I will mention it anyway because I find it so important. So right here on this number, it did not stop right here. It went all the way down here. People have asked me why I use our product a lot, and why wouldn't you put in orders with a mouse? Why would I not put in orders with a mouse to cover right there? Because as you see, this was an area of support before, and also if you look at the down channel here, that kind of intersects right here. Why would you not put in orders there ahead of time? It's because you never know how far it's going to go. So you have this dilemma all the time a trader will face. Should I, I think something's going down. Should I put in my order now, or should I wait until the market starts coming in that area and then do the best thing I could possibly do at that moment? And to me, that is the better answer. That's why I use the keyboard, because you can be extremely fast, but still, still be faster than almost any manual trader. But are there times that I will put orders at specific prices? Definitely. If you have specific chart points that are so obvious, yeah, obviously you could do that. And if you have a large position and you need to scale out, without really keeping all of your risk, you're starting to sweat a little bit, your position size is larger, yeah, then you could put in some of your position to scale out at specific price points. But personally, I think there's a larger edge in waiting till the market comes towards the expected range that you plan on and covering at the price that seems best at that time. And if it blows through it and gives you a better profit, then it's your lucky day. Any more questions right now?
Adam, I wanted to ask, so you said that you've been trading for 15 years. So at what point, I'm just trying to understand your process where you basically hit a wall. This is what I'm picturing in my head. You hit a wall with the speed in which to send your orders and manage your orders, and that led eventually to the keyboard. We saw some other people on BMT asking about using scripting tools and stuff. I mean, what was your process that finally led you to making a piece of hardware? That's something that most people wouldn't end up doing.
Yeah. Well, number one, I always felt like there are qualitative events that happen in the market that someone with an algo is going to get absolutely creamed on. And this is just one of the reasons, but I'll give you an example. Do you remember the hash crash? Not the flash crash, but the hash crash that happened when someone hacked into the Twitter account, the AP Twitter account, and released a note that said that the White House had been bombed and the president was hurt.
Right. Yeah.
What happened during that moment? If you had your algos running and you saw the stock market go down and otherwise it was a positive environment, you would have bought it. And if you saw gold go up, you would have sold it. But what was happening in reality was much more important than what was happening in the charts. And if you had a serious event, then what was happening in the charts actually was not even significant. If the president was killed, today's and yesterday's chart wouldn't even be on the chart anymore. It would be off the chart.
Right.
So, obviously there's certain things that qualitatively, I don't care what some people say about machine readable news. That might work for very advanced people with a lot of money, but for all intensive purposes, there's way too many things that are qualitative in nature that a machine is not going to succeed at, and a human will. And I made money that day because I was one of the first people that put in my orders to buy gold and sell the S&P before all the other manual traders. Okay. Now, another reason is because I just felt like consistently, I started trading with keyboards in 2003, 4, 5, and I just felt like I still had enough time to make my move. So you had economic data coming out, and everyone's talking about, oh, traders are leaving the business, it's harder to trade these days, the algos are taking over, and I started using keyboards, and I felt like, I don't know what you're talking about, because I was able to, okay, let me give you an example. Market moves like this, and then it goes down, it stops. It moves like that, and then it stops. It goes like this. You have these moves, and I've kind of loosely in my mind timed them to being like, somewhere between a half a second and a full second that the market stops at. It goes like this and it stops. Well, as soon as it goes up and it stops, if it stops at the upper end of an expected range, I'm going to be the first one doing a sell join or sell improve iceberg, selling a 10 lot or a 20 lot. And I don't care if you're an algo that you have to program and reprogram and recalibrate your algo. I did it with no money to program, and I did it in real time without the risk of doing it at the time of incorrect qualitatively, if that makes sense. I did it at a time that was based on there being no qualitative information to support my trade, if that makes sense. Whereas an algo would make this move. They might be able to fade something, but they might do it based on qualitative information that was incorrect, or they might actually wait for someone to make the move before them. So a lot of ways algos work, and this isn't, by all means, this isn't everything, but a lot of algos, they wait for someone to make the first move. So I'm often happy to make the first move because I know that other traders are waiting for someone to take that first move. So market surges down or surges up, it's just waiting for someone to tip it the other way. So it doesn't matter.
Sorry about that.
It doesn't matter if you're an algo person. You could do the same thing. It just matters whether you're fast enough.
Okay, so I'm trying to picture. So, I mean, since you can just hit like one key and you could have it programmed to do a lot of different things, it would be possible that one key could get you into multiple markets, but yet you said that you primarily trade gold. So do you not see any interest in, fading the S&P with whatever you're trading, gold or any other kind of correlative markets? You still prefer just to focus on one market?
No, I mean, it's a good point. I was talking about for the data releases that I usually focus on one market. And for me, when I say gold, I almost always mean I'm trading gold and I'm watching and sometimes trading silver too. So on my keyboard, I have a special function. So I'm holding my thumbs right here against these two keys, right? And this one is an iceberg key, and this one here says join. On the keyboard that I use, it's a little bit different than this. So for me, if I press this, normally I would be buying gold. But if I hold this down and I press this, now I'm buying gold and silver. So I can decide whether, on the fly I want to buy one product or buy two products. And let's say you wanted to liquidate. Let's say you had a position in the S&P, gold, silver, crude oil, whatever, and all of a sudden you want to liquidate one on the inside bid or offer. You could either manually with your mouse go across every static price ladder you have and buy one here and sell one there and do it one by one, or you could do something like this. Hold down a key and press liquidate. And the way that this keyboard works is only for one product, but we have another version that if you did this, it would liquidate 6 different products at the same time. So on the inside bid or offer, if you hold join, and if you just push this, it'll do it taking it aggressively. So I personally, on my keyboard, I'm looking at price levels. So if gold's come down, and I'm looking for a buying opportunity, and I just see it in gold, then I just buy gold. But if I see gold and silver are about to jump at the same time, for me it's just like that. I'll do it again.
Right.
I just held this one down. I bet no one even sees it. I just did it in a third of a second. I bought 2 products.
Well,
so yeah, I use it all the time.
Okay. So tomorrow, Fed minutes come out. There's going to be a lot of move, on multiple markets. Are you generally? I mean, how? Well, that's a good example. I mean, tomorrow, given the news, and it's bigger news than usual. So walk us through what that looks like. Your process. What are you doing tonight? What are you doing tomorrow morning ahead of news to prepare for all that?
Well, the first thing I'm going to do, and by the way, I just turned on my monitor, my gold monitor, so I could, give a little bit more context to it. So just note, after a weekday yesterday and a weekday today, where gold closed at 1250.50, now it's at 1255.60, so it went up $5 after the close. Is it the short covering I'm talking about? And I'm not bullish on gold. Don't get me wrong. I have really, I'll do either side just as easily. But with regards to what we were just talking about, I will usually on a number or usually on a Fed statement, I will be trading gold and silver at the same time. I will be holding down my basket key because they will both move at the same time. I will usually not trade the Dow or other markets at the same time. Usually my Fed days, my jobs report days, I'm always trading gold and silver together. And then obviously I start trading one or the other based on when each of them is hitting different areas of the chart that I expect to be support or resistance, to break through support or resistance, et cetera, et cetera. Regarding what happens between today and tomorrow, I would say it's less important than what happens after the report. I would say, after the statement. I have been caught way too many times with positions before these statements, and like I said before, it's usually just not worth it. I will review what happened, what the last statement was. I will listen to Bloomberg, and I will listen to 5, 10, 15 people and give their opinions. I'll do some reading. For me, trading gold, I usually look at the statements. People write articles on Kitco. I watch emails I get from Sharps Pixley. They do nice reporting and link to a lot of good research. But generally, the trusted research and trusted opinions are from, and the media people, right? I would say, just to put it in perspective, and I hope that this answers it a little bit better. The point of me listening to all these opinions is not to learn something and do what they're suggesting you do. The reason is to understand what the context is. So if you listen to the news tonight and you listen to 10 different people talk about this taper, and everyone expects there to be a continued taper tomorrow, then that will help answer the question of what would be the move in the opposite direction if they're wrong, right? So it helps put things into context. And if there is a taper and everyone expected it, then that's no news. So it helps you. It helps give weight and clarity to what happened after the number came out.
Right.
And I don't need to overtalk this. I think you get it.
Sure. Let me ask a little bit of a different question, changing gears for just 1 second. So you're trading hundreds of turns a day. You have memberships, so obviously your commissions are lower than somebody that's only trading 5 times a day or 5 contracts a day. Do you think that? I mean, is that part of your edge in the sense that you need that in order to be profitable? Is it possible for average Joe to come along and trade the news, without memberships, paying regular commissions, and still, have a good living?
Yeah, because there's so much action on the news that it dwarfs the price. It dwarfs commissions. So I would say, definitely. I'm glad you asked the question. Separate what I'm talking about from. Recognize the difference between trading actively and over trading, right? So on a data release, just because I have 2 hands on a keyboard doesn't mean that I am in any way saying that over trading is good. I think, you have to know when to be active and when to be hands off. But that said, if you had sold the S&P halfway into the move today, and maybe you got a point out of it, so you still made $50 and your commissions was, even if you're barely trading, it was probably still only a few bucks or less. So, and that's 1 point. So, yeah, I mean, basically the COMEX membership I have, that saves me a buck a side. So it's still only 1/10 a tick, because 1 tick in gold is $10. So, yeah. So I would say the memberships actually help you save money if for all the other trades, but on the very active moments like data releases, that's when they actually matter the least.
Okay. And just another question in general that I wanted to ask. So whenever you're just an example trade, just a general trade, are you putting stops in at the same time? Do you have profit targets in? From what I gathered, you don't. You're waiting. Is that correct? You don't have OCOs setting on the market waiting ahead of time as soon as you're in.
Okay. So I sometimes use stops. Sometimes I stop into positions, and sometimes I stop out of them. It depends how obvious certain chart points are. And when I say obvious, I mean I don't just mean like, high and low of the day, but if you had people buying, and you're not going to see this in the S&P. It just happens too fast, I think. But if you saw people buy 20, 30 contracts, one lot at a time at a certain price in gold, and you saw the time in sales over and over again, it just hits that number, but the number's not going away. You know that someone's got an iceberg order at that price. I might put in, even if that is not a higher low of the day or any other interesting point, I might put a stop one tick above it. You could say a stop limit at that, one tick above it to pay maybe one tick higher. That could be a good trade. But usually I feel like my edge is making the correct decision much quicker than the average person because of the product that I use, and I try to leverage that.
Okay.
But yeah, if there's obvious situations where a stop will help, I try to do that. But
Okay. So not just stops,
it's a little hard
but understood. I think it's not just stops, but also predetermined profit targets. You have areas in mind, perhaps, but if I'm understanding you correctly, those orders are not resting on the exchange ahead of time.
Right, exactly. So going back to gold, so my profit target, so I missed it a little bit. Well, I missed it actually probably by $3-4 today, but was this it? Yeah, so my profit target for gold in this area was right around here. I thought it was going to make, I didn't even think it was going to go up here, but somewhere between, here and here. That was where I was looking for. Then it ended up making a new high for the day up here, and you could say maybe that was predictable. Who knows, But for me, it was 10 minutes after the trade, and I said it kind of did what I wanted to do. It went to the other end of the range. It took a weak number, economic data point, to drive it to the other end of the range. That was my goal. So I didn't put my orders to sell in ahead of time, but once you saw it flash to that level, then I'm liquidating. So if I'm, for instance, sell joining my entire position at whatever the offer price is, whether it's here or here, I'm happy. I don't care if it ends up that it only went there or that it went there or it went there. As long as I know that I'm trying to sell within a half second of when it bursts up there, then I think I've done what I tried to do.
Okay. I wanted to ask one other question also, and then I'll move on to questions from other people. So other than news events, what other trades are you taking during the day? Is it primarily what you just described in watching order flow, basically looking for stopping points and fading them, or describe the non-news report trades?
Okay, sure. Let's look at, I'll go 30-minute chart right now. Okay. Let's do a 1 hour chart. So this is 1231. That's right here on a daily. So we have a daily on the left, right? Okay, so this is 1231 right there on the left side. And when this, what time of day is this? So this day right here, India came out with news that, I'm sorry, India did not come out with news. Someone if I have this correctly. If I don't, then you can, or someone can tell me I'm wrong. But I believe it was a woman who was the widow of a former person in power in India, wrote a letter to the Indian government saying that they should reconsider the large 10% tax they're putting on gold imports. And that sent the price of gold moving up very strongly. And in the morning, it was right here. Okay? And I guess you could say this is news related too, but I didn't actually intend this to be news related. But this is a market event that was unexpected, and it took it outside the range of where it was trading. Now, you have to realize that this is January 20th, 21st, 22nd. So 2 days had gone by here, and in this 2 days, gold's been very weak. So if you told me you're going to get another chance to sell somewhere up here in this mid-40s range, I would have said, I'll take the first new high. Maybe it makes a new high above 44, 45, 46, and then the rest of the day it's going to tail off like this. But so when I woke up in the morning and I looked at this, the market was up here, but it was extremely strong because it wasn't a burst which failed after 15 seconds. It was a move that was holding up here at what I thought was generally a high outside of the range that it should have been trading at otherwise. So you have to, okay, I won't say you have to. The way that I look at things is if I'm looking for short opportunities, a great short opportunity is for no good reason, the market's just kind of range trading and it makes a new high, and I would short the heck out of that high. That being different from, in this case, the market made a high but is sitting at higher levels on a good reason that took the market by surprise, and you say, hey, if enough people are caught off sides, I want to trade it. If this makes a new high, I'm going to trade it and try to go towards, and then where should I trade it towards? Well, it was down here. Did I know that it would stop right here in the high 60s? No, but I think I started buying it somewhere around here. I don't know where actually I was, but I remember I did start liquidating it once it reached the end of this channel. So I would say in this case, there's an opportunity that I took information that the market gave me. I resisted the opportunity to do what I wanted to do, which was short a bounce, a failing new high. And instead I took the other approach that said enough people are going to be caught off sides here that I used that as an opportunity to get towards the end of the range. Then you kind of let it peter out, and you say you don't take any serious new positions in this area because now you have new information. You let people say, okay, chances are this news will actually not have an impact right away, and maybe it'll be considered, but nothing serious right away. The Fed's coming up. The Fed's coming up. The Fed's coming up right here, somewhere around here. Some people are going to still want to sell. And then you basically look for opportunities to fade that new information. But it doesn't always happen right away. You have to wait until it peters out.
Okay, Jeffrey is asking if you can give an example of a trade that did not work so well and how you dealt with it.
Which hundreds of thousands of
if I can, let me add one thing to that. I mean, do you find generally that you have a high win percentage, or are you simply earning more than you're risking on every trade? How does that balance out for you?
I heard the first part. I didn't hear the last part. Do you earn more than?
Sorry.
Say that.
Do you find that you have a high win percentage, or do you find that you simply earn more on your winners than you're risking?
Good question. I do have. I think I usually make about money on, I don't know if it's 70, maybe 70% of days. Maybe I lose 10% of days, 15% of days. Maybe 15 or 20, actually 20%. Let's say 20% I make on 70, and then I net even the others. In general, my winning days are, and I'm answering it in days, not in terms of trades, but
sure.
I would say in general my winning days are usually maybe slightly bigger than my losing days, but it's pretty close. I mean, you have those big losing days every once in a while, that hurt. But I would say, just as an interesting tidbit on that, for me, and this isn't for everyone, everyone has their own style, and again, I have a stats background. I like analyzing my trade history. My experience is that for me, the biggest problems that I have is when I'm up a lot on a day and then I start having a loser that I don't see as a loser. I see it as, oh, it's just temporary, because let's say you're up a lot on a day and you're seeing green, everything's green, right? and you do what you're trying to do for the rest of the day, and now it starts going against you because you're still green in a day. Somehow, for me, I've had a little extra confidence because I still see all this positive money in my account, but that's the biggest risk for me. So I'll answer a little bit what we had the question before in a little bit of a different way. You had said, what do you do about it? How do you handle it? This is something that I'm going to do very soon. It's not ready yet for our product, but I believe in risk management. I believe in analyzing your trades, finding out what you do right and what you do wrong with extreme amount of detail. So to me, this means, and tell me if I'm going off track, Mike, but you're asking how I deal with it. This is actually how I deal with it. If I have a big losing day, or if I have a big winning week, it doesn't matter. I am analyzing what happened, right? So for me, that means download your trades, and I think you can download. If you use T4, I think you can just get them from Excel. If you use our product and using our transactional system, we collect all of your trade data if you want us to, and we can offer it to you, for free for data analysis. You can get the data if you're using other software. I don't know. I know a lot of people use NinjaTrader. I don't really know what they do, but a lot of systems, you can get access to your trades. Some brokers, they don't actually give you all the data you need. I personally find one of the variables that brokerages don't often give you, it's extremely important, is the time of day of your trade. For me, I find specific times of day are very profitable and specific times of day are unprofitable, and that to me is very important. So number one, you learn what are the common reasons you make money, what are the common reasons you lose money. Sometimes it's the product that you're trading. You just don't have a history. You don't have an understanding of it. Other times you're trying to trade too heavy after the markets have stopped moving. That's usually the number one reason for most people. And then you learn from it. But I think the more important question is, how can you actually help what you use what you learn to make more money? I am in process of working with our programmers to build methods that integrate Keyboard Trader with Microsoft Excel, and that's going to allow me to build a risk system in Excel. So what I plan on doing is building methods so that based on the time of day, it's going to increase my buying power or reduce my buying power. If I have a winning day that starts going south, it's going to liquidate me automatically. Customizing a risk system to me is going to be the most exciting project that I've been able to do, and I've already got a lot of ideas for it. But even if you don't have something like that, or you're using another system, you don't want to use ours, there's lots of ways that you could still use these ideas. Simply study when you make money and when you lose money, and you could program your computer to give you alerts to stop trading at a certain time.
Right.
So there's lots of things you can do.
Let me ask one final question, and then we probably need to go. How much time, if you were to compare the time spent actually placing trades, okay, or in the mode ready to place trades, compared with the amount of time spent analyzing and researching, how do those two compare to each other?
I make most of my money, and this doesn't answer your question, but this answers what I should have the answer be. If I had my risk system built and done and in use, I make most of my money between it is 8:40 Central and 10 a.m. Central, if there's no excess volatility or nothing really important going on. So I also trade the news events, and then I stop. So you have news, between usually 7:30 Central to 7:45 Central. I'm active. Then I'm active 8:40 Central to 10 a.m. or even sometimes 9:45 or earlier Central. So that's in total so far an hour and a half or so. And if gold's really active, I'll trade it any time of day, and I'll trade it at 2 in the morning. But in terms of preparing for that,
Right. How much time
I
do you
might
spend
spend as
on
much
it?
time reading and listening to news.
Right.
Yeah, and then analyzing trades. That's all on the weekends. That's evenings. I might spend 3-4 hours analyzing my trades each every 2 weeks or so.
Okay. Okay. I was just trying to get a feel for how often you're in Excel versus how often you're staring at a dome. So okay.
Yeah, I would say absolutely staring at the dome and the charts while the markets are going on. I have 2 hands on the keyboard, and I am extremely ready at all times. But I would say if I place, let's say, a few hundred round turns a day, and maybe they're not one lots, they're usually bigger. I might be there ready to place a trade. I mean, a trade only takes a fraction of a second to put in, but I would say, how do you say this? It might be every few minutes I place a trade. It might be every 5 minutes. I might put in a trade and hold it for 5 minutes. I would say the average hold time for me that I should have, as I said, is less than 10 minutes. After that, it starts going downhill. But I've also studied, after I liquidate a position, how long I should stay out of the market before I should get back in. And the data is a little bit less conclusive for me, but I've found that if I can wait sometimes 1 to 2 minutes after each trade before I put in the next trade, that I will usually be more profitable. But that's something I don't know for sure yet.
Okay. I only asked the question because from a high-level point of view of me looking down over, all the users on the forum, 50,000 people, and they write journals and all kinds of posts, it seems to me that there's a correlation between the people that are not profitable and the people that are when it comes to it's almost counterintuitive, but what my experience is that the people that are not profitable are actually spending more time staring at charts and less or no time analyzing actual trades, or call it Excel time. Whereas people that are more profitable actually spend less time on the charts and more time on the researching and analyzing of their trades. So it's almost counterintuitive maybe to some people, but that's what I've found, and I just wanted to see what your experience was in that area.
Yeah, I think you're right. I think a lot of it has to do with over trading. So for me, if I were to trade just from economic data until 7:45 Central and then stop and then wait until 8:35, 8:40 and trade for an hour and a half on a regular day, just all the things equal, I would be good. And in that case, I will kill it if I am very active. But if I am stepping outside of those bounds, I will not kill it. It will kill me. So I would say it depends on how well you know. It depends on how well you know yourself. It depends on how well you know your data. It depends on how much data you have to analyze. I mean, if you've only been trading for a year, you've only got 20 trades to analyze, don't even try it, in the way that I'm talking about. But yeah, I would say for most people that don't have these time frames understood, that don't understand what their edge is, if you try to do too much in a way that you don't understand, what the benefit is there, the most likely result is you're going to end up trading with yourself. You're going to be in a low volatility, low volume environment, trading with yourself and losing your money.
Right. Okay. Well,
Definitely.
we should probably stop. The Q&A part is my favorite part of pretty much every webinar. Not too many questions from members today, but I had several of my own. So let me just ask one final thing, and that is, if people have other questions that they come up with or are watching the recording at a later date, what's the best way for them to get a hold of you? Is it email? Is it website? Is it a phone number? What is it?
I mean, I like email the best, but I mean, you can go to our website. That's keyboardtrader.com. You can email me at asheldon@keyboardtrader.com, Sheldon at keyboardtrader.com. And then, Mike, I don't know if you saw, I don't know if I even remembered to ask you this, but I do have some extra notes on this discussion today, so if anyone wants them, I'm happy to send them out. It's about 3 pages of a little bit, the kind of detail that I talked about today.
Okay.
Yeah, and if people have questions, just shoot them.
Okay. Well, Adam, I really appreciate your time, and definitely would like to invite you back later. I could continue picking your brain on the Q&A for a long time to come. So we'll work on some other kind of webinar here in a few months and have you back on, okay?
That sounds great, and I will pick your brain at some point, too. I don't know if we ever invert the process, but that would be fun.
Every now and then. All right. Thanks, Adam.
All right. Mike, thanks very much, and thanks to everyone for listening.
Yeah, thanks, guys. Bye.
All right. Bye-bye.